Heloc. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And today, in this video, I want to talk to you about home equity line of credits. If you've heard this term before and you own mortgages, this video is for you. So tune in and let's get started right at the beginning. Heloc, what is that? First, let's talk about what home equity is. Home equity is what someone is willing to pay for your home subtracted by what you owe your lender. It's this difference that is called home equity, the equity that you've built into your home. It is essentially the amount of the home that you actually own. For example, if your home is worth $600,000 and you only owe $200,000 to the bank, then really you only own $400,000 of your home. Now, the amount of home equity you have in your home can vary at any given time. You see, you are making consistent payments to the mortgage, so the balance is going down. On the other side of the equation is what your home could sell for. As you know, the market can change. It can go both up and down. What's interesting about home equity is it's actually an asset. You see, you can go back to the bank and refinance your loan or to another lender and get more of that home equity out of the home as debt. Many homeowner taxpayers tend to use this money to pay off credit card debt, to pay school tuition for their children, to renovate the home, and sometimes even to buy another property or boat. Homeowners can typically borrow up to 85% of the equity in their home. Different banks have different thresholds. That's basically an average. Now, there's a difference between what I just described, a home equity loan, and a Heloc. You see, a home equity loan is pretty straightforward. You're taking a loan against the equity of your home and it has a fixed payment with a fixed interest rate. A home equity line, on the other hand, is a revolving balance, almost like a credit card. There's an amount that the bank allows you to use and you can draw from it as needed. So what are the pros to having a Heloc? Well, the first one is that you can actually use the funds for whatever you like. If you don't use the funds to renovate your home, then you can't deduct the mortgage interest that you pay on that line of credit. So that's important to keep in mind. 2, typically home equity lines have lower interest rates when you compare them to things like credit cards. 3, you pay exactly what you owe. In other words, with a home equity loan, even if you haven't used all the proceeds of the loan just yet, you're still paying the same fixed rate, fixed payment. But with a home equity line, since you can draw and pay back, you're only paying exactly what you drew that you need to pay back. So what are the downsides to having a Heloc? Well, the first one is a variable interest rate. The interest rate is not fixed, and in an inflationary environment like we're at now, that means interest rates continue to go up for those taxpayers that have a home equity line. The second is fees and minimum withdrawals. Many times, lenders that grant Helocs typically have specific requirements of how much you minimum need to borrow and also what kind of fees you'll incur annually for having the home equity line of credit. And 3, you're putting your home at risk. So it is a big deal to take out a home equity line of credit. You really want to make sure that you're going to be able to pay it back because the collateral, if you don't, is that the lender can seize your home. We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.